Can you buy a home without a social security number? In many cases, yes. There are mortgage programs designed specifically for borrowers who uses an ITIN, ITIN, or individual taxpayer identification number instead of using a social security number. And these programs can provide financing for borrowers who do not need or do not fit rather a traditional mortgage guideline. So let's look at who I-10 loans are designed for, how much you need to put down on an I-10 type mortgage loan, the different types the different types of ways you can document income, and what credit requirements may look like, and what type of property you can actually finance with an I-10 or individual taxpayer identification number type mortgage program loan. What exactly is an I-10? An I-10 is a 9-digit tax processing number issued by the IRS. It's available to certain people who need a U.S. taxpayer identification number for federal tax purposes, but aren't eligible for a social security number. One important distinction: an I-10 number does not give someone special immigration status and does not by itself authorize someone to work inside the United States. It's a federal tax identification number, but certain mortgage programs allow an eligible borrower to use an I-10 instead of a social security number when applying for financing for a mortgage. Who are I-10 mortgage programs designed for? Many I-10 mortgage programs are designed for borrowers who live in the U.S., use an I-10 instead of a social security number, have income or assets that can be documented, and want to purchase or refinance U.S. real estate. One of the biggest advantages is primary residences are allowed. That makes I-10 financing a potential path to home ownership for someone who lives in the U.S. but does not have a social security number. Depending upon the program, second homes and investment properties may also be eligible. How much money will you need to put down in an I-10 mortgage program? This is one of the biggest questions borrowers have, obviously. In some current I-10 mortgage programs advertise as little as 10% down. That's on qualifying transactions. The actual down payment will depend on things such as the credit profile, the income documentation method, the property use, the property type, the loan amount, and the overall strength of the applicant itself. But the important point is, I-10 does not automatically mean a huge down payment. There are qualifying programs where 10% down may be available. How can you document your income? This is where I-10 financing can become particularly flexible. This isn't just one way to qualify type mortgage. This is like a non-QM type mortgage program, or a non-qualifying mortgage program, they call it. And there's more than one way to qualify using different types of income sources. Depending upon the program and how you earn your income, there can be several options. Option one is your typical full documentation loan. If you're an employed borrower, a W-2 employee, full documentation qualifying may be available. Depending upon the programs, that includes such thing as employment verification, your W-2s, pay stubs, tax returns filed using your I-10 number, and other standard income documentation. Self-employed borrowers may also have a full documentation option using personal and business tax information, but full documentation is not the only route. Bank statements for someone who is self-employed and owns a business. Some I-10 programs allow qualifying using 12 or 24 months bank statements, depending upon the program. Those may be either your personal bank statements, your business bank statements, or even a combination of both. The lender evaluates these bank statements, deposits, and business cash flow rather than relying exclusively on the taxable income shown on the traditional tax return. For a self-employed borrower, that can make a significant difference in qualifying for a mortgage loan. Another option, a profit and loss statement. Another available method with some I-10 programs is a profit and loss qualification. A self-employed borrower may be able to qualify using a 1-year profit and loss statement, supporting by recent bank statements depending upon the program. This can provide another way to evaluate the actual performance of the business, which without relying entirely on tax return income. Option 4, 1099 income. For independent contractors, 1099 income will allow an alternative documentation method. Depending upon the program, 1 or 2 years of 1099s may be used along with documentation of current income. This can be useful for contractors, freelancers, commission-based workers, and other borrowers who don't receive a traditional W-2 salary. Another potential option is asset utilization. Instead of relying entirely on an earned monthly income, eligible assets can be evaluated and converted into qualifying income under the program's formula. Depending upon the program, eligible assets may include cash, savings, brokerage accounts, investment accounts, and other qualifying liquid assets. This can be useful for somebody whose financial strength is reflected more in their assets than in a traditional monthly income. What about purchasing an investment property? An I-10 borrower is purchasing investment property. There are also programs specifically designed for investors. Some I-10 investor programs allow DSCR qualification. DSCR stands for debt service coverage ratio. Instead of qualifying primarily from the borrower's personal income, the lender evaluates the investment's property rental income. Current I-10 investor programs are available specifically for this type of transaction. So an I-10 borrower may also have more than one financing path for a home that they're going to be. So an I-10 borrower may have one financing path for a home they're going to live in, and different qualification method when purchasing a rental property. So what credit score do you need for an I-10 mortgage loan program? Current credit requirements they vary significantly between the different I-10 programs. But some current programs start with credit scores around 640. And here's an important point. No social security numbers does not mean no credit score. Many I-10 borrowers can still establish traditional U.S. credit history and have a U.S. credit report and credit score. So as an I-10 borrower, if you've been using such things as credit cards, auto loans, installment accounts, or other accounts that are reported to the credit bureaus, you may already have an established U.S. credit profile, even though you don't have a social security number. Other programs may require higher credit scores depending upon the down payment, the property type, income documentation, loan structure, and other risk factors. Some programs can also consider non-traditional credit when appropriate. That may include documented payment histories such as rent or other recurring obligations. So a limited traditional credit file does not necessarily mean that there is no financing options for you. How much debt can you have? For qualifying based on your personal income, the lender will also evaluate your existing monthly obligations. Some current I-10 programs allow debt ratios as high as 50%. That doesn't mean everyone automatically qualifies at that level. The actual allowable debt ratio will depend on the rest of the loan file itself, including the credit, the income, the assets, the down payment, and the documentation. But I-10 programs can provide meaningful flexibility compared with more rigid underwriting structures. What types of property can qualify? Depending upon the program itself, I-10 financing may be available for primary residences, second homes, or investment properties. Eligible property types may include single-family homes, townhomes, PUDs, planned unit developments, condos, duplexes, triplexes, fourplexes. Certain programs also, they'll allow non-warrantable condos. So the borrower isn't necessarily limited to a standard single-family home. The property simply has to meet the guidelines of the specific I-10 program. What about reserves? Some I-10 programs require the borrower to have reserves remaining after closing for covering the mortgage payment itself for 6 to 12 months. Reserves are additional liquid assets available after you've paid your down payment, your closing costs, and any other required closing funds. Some I-10 programs out there, mortgage programs out there, only require 3 months of reserves. Other programs may require less depending upon the transaction. So when preparing to buy, don't look only at how much money you need for the down payment. also find out how much money you need to have left over after closing for reserves for qualification. Can you use gift funds? Depending upon the program, yes. Some I-10 programs allow gift funds to be used towards the down payment or other eligible transaction costs. The amount can come from a gift, and whether the borrower needs to contribute some of their own funds depends on the program and the loan structure itself. So family assistance may be an option, but it needs to be documented correctly. So how much money can you borrow for an I-10 loan? I-10 financing isn't limited only to lower price homes. Some current national I-10 programs offer loan programs up to $1.5 million. The maximum amount available will depend on the borrower, the property, the credit, and the income documentation being used, and the overall strength and structure of the loan itself. But these programs can accommodate a fairly broad range of property values. What should you have ready before applying? An I-10 borrower should generally be prepared for some combination of identification, valid I-10 documentation, and a government-issued identification, income documentation, depending upon how you're qualifying, employment documentation, tax returns, bank statements, P&L statements, 1099s, or any other qualifying asset asset statements for documenting if you're going to go that route on an asset-based qualification. Funds you're going to need: down payment, closing costs, and required reserves, credit or payment history when required by the program. Having these items organized before you start shopping for a home loan can make the financing process much smoother. Transition to close: not having a social security number does not automatically prevent you from becoming a homeowner. The important thing is figuring out how you earn your income, what credit profile looks like, and what assets you have available. Which I-10 program fits your situation? It all depends. I'm Jim Kennedy with Kennedy Mortgage. If you use an I-10 and you're looking to purchase a property here in Texas, feel free to reach out. We can look at your income, your credit, your assets, the kind of property type you're looking at buying, and the different ways you can qualify for this particular mortgage loan. Determine which I-10 mortgage program best fits your needs and which ones are available for you.